Today, we're breaking down SAP, one of the world's most important software company most people never think about. SAP runs the financial systems, supply chains, payroll and operations of some of the largest businesses in the world. These aren't optional tools. If SAP goes down, companies can't operate. I'm Edward Khalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. In this video, we'll analyze SAP using our 5 key factors to see whether it's a durable long-term compounder or a stock that's already fully priced. We'll look at the economic moat, returns on capital, growth, financial strength, and its valuation. Before we look at numbers, we need to understand why SAP is so difficult to replace. SAP's moat is built on deep integration and switching costs. Large enterprises don't use SAP for one task. They use it to run their financial reporting, manage inventory and logistics, handle payroll and HR, coordinate procurement and suppliers, and comply with local and international regulations. Once SAP is embedded, it becomes the operating backbone of the business. Switching away from SAP isn't just expensive, it's risky. It involves multi-year migrations, retraining thousands of employees, rebuilding custom workflows, and potential disruption to core operations. This creates long customer relationships, often lasting 10 to 20 years or more. Now let's look how SAP compares to peers. Oracle offers similar ERP lock-in, but with a more legacy-heavy perception. Workday is strong in HR and finance, but narrower in scope. And Microsoft has a powerful ecosystem, but ERP is not its core focus. SAP's business model is simple. Sell mission-critical software, integrate deeply, generate recurring revenue, and retain customers for decades. This mode doesn't create explosive growth, but it creates durable, predictable cash flows, which is exactly what long-term investors want. Now, before we go into the numbers, this is where the story needs to be backed up by data. To break down SAP's returns, growth, balance sheet and valuation, I'm using Fiscal, the research platform I personally use. If you want to follow along with the same charts and peer comparisons, the link below includes a 15% discount at no extra cost to you. A strong moat only matters if it translates into real returns. SAP's return on invested capital is 11.5%, for Oracle it's 11.3%, Microsoft sits at 23.9% and Workday is at 4.1%. SAP's return on invested capital is solid and nearly identical to Oracle, reflecting mature enterprise software, ongoing reinvestment in cloud infrastructure, and less operating leverage than Microsoft. Microsoft's much higher return on invested capital reflects its massive scale and dominant cloud and productivity businesses. Looking at return on equity, SAP sits at 16.5%, Oracle at 82.4%, Microsoft at 33.3%, and Workday at 6.1%. Oracle's return on equity is inflated by aggressive share buybacks, which reduce equity and mechanically boost return on equity. Importantly, these buybacks have slowed in recent years. SAP's return on equity is clean and operational, not driven by financial engineering. SAP doesn't generate Microsoft-level returns, but its returns are healthy, consistent, and supported by real operations. Now looking at growth, SAP is not a hyper-growth stock, and that's okay. Over the past decade, revenue grew at a compounded annual growth rate of 7.1%, net income grew at a CAGR of 9.7%, and earnings per share grew at a CAGR of 9.6%. Compared to peers, Oracle grew earnings per share at a CAGR of 8.6%, Microsoft at 20.4%, and Workday recently became profitable, so it's not really comparable yet. SAP's growth profile reflects a mature enterprise customer base, a shift from licenses to subscriptions, ongoing cloud transition with RISE with SAP. This is steady compounding, not exponential growth. And that fits SAP's role as a core infrastructure provider. SAP's balance sheet is one of its biggest strengths. SAP has 9.7 billion euros in cash and cash equivalents, 9.5 billion euros in total debt, and 9.9 billion euros in free cash flow. This means SAP could theoretically repay all of its debt in less than 1 year using free cash flow alone. Free cash flow to total debt is extremely strong and confirms low financial risk, high flexibility, ability to invest, acquire, or return capital without stress. This is exactly what you want in a long-term compounder. Even the greatest companies can be poor investments when investors overpay. So how is SAP valued today? SAP trades at a forward price-to-earnings ratio of 23, Microsoft sits at 23.7, Oracle at 20.4 and Workday at 16.7. SAP trades roughly in line with Microsoft and at a premium to Oracle and Workday. The market clearly views SAP as a high-quality, durable software business, but not a bargain. Now let's look at the PEG ratio to account for growth. Analysts expect 17% long-term earnings per share growth driven by the shift to cloud subscriptions, strong S/4HANA migration demand, and margin expansion as cloud scale improves. That's the bullish case, but historically, SAP has grown earnings per share at 9.6% per year, steady but not aggressive. Now let's look at the PEG ratio from two perspectives. Using forward growth of 17.1%, we get a PEG ratio of 1.35. Using historical growth of 9.6%, the PEG ratio is 2.4. That's a big difference. That's why I prefer anchoring on historical growth and treating forward estimates as upside, not a guarantee. SAP looks fairly valued if the cloud transition continues smoothly. If growth reverts closer to history, returns will be solid but unspectacular. This is a quality compounder, not a deep value play, and expectations matter. So here's the bottom line on SAP. This is not a hype stock, it's not a turnaround, and it's not a moonshot. SAP is a mission-critical enterprise software company with a real moat. Once businesses run on SAP, switching is expensive and disruptive. Over the last decade, SAP grew revenue around 7% per year and earnings close to 10%. Today the stock trades at roughly 23 times forward earnings, which makes it fairly valued, not cheap. If the cloud transition continues and margins expand, SAP can compound steadily over time. If growth slows back toward history, this becomes a quality hold, not a high return play. What do you think? Is SAP a long-term compounder or already fully priced? Don't forget to like and subscribe.